Hello everyone, it's me Bisarel. Today I'll be talking on the topic of navigating the financial landscape, that is costing, budgeting, and cost of capital. In this presentation, I'll be talking about the importance of costing approaches, capital budgeting, and cost of capital, and their implication in real life or business. We'll be talking about how the business, how the organization uses these financial instruments in their real life, and how they uses in order to operate and function their activities. So we'll be talking about this in later part of this presentation. So I'd like to move towards another slide. So we'll talk about costing approaches. We have already talked about the costing approaches actually. There are basically two types of costing approaches, that is absorption costing and variable costing. But sometimes organization or business use activity-based costing as well in order to allocate to the particular activity in the business, and they're part of costing for this businesses or organization uses this technique in order to determine the particular part of costing in the particular activities. So we have already talked about absorption costing and variable costing. Absorption costing is nothing that includes all the manufacturing cost, is the product cost that includes both variable cost and fixed cost, both. And variable cost, in variable costing, it this includes only variable part of manufacturing cost as a part of cost, while other fixed costs and other fixed manufacturing costs are recognized as the predicate cost, and they are charged in the income statement. These are the costing approaches. So we'll talk about capital budgeting technique. We have already discussed about the capital budgeting techniques actually. There are three main terms or main instrument tools in capital budgeting, that is NPV, IRR, and payback period. NPV is the present value of future cash flows. Future cash flows are discounted at certain rate, and they are brought in the present value, and that is called the NPV. And IRR is the rate. We discount all the future cash flows and make them zero, and that rate which makes all the cash flows of the future and makes them zero in the present, and such rate is called IRR. And payback period is nothing. At first you invest some amount of capital in the business, and payback period is that time where the business provides you return, and you will get full amount of capital invested in the initial phase, and the term of period, and that period where you get your full amount invested back to you. That period is called payback period. Weighted average cost of capital and importance, we'll be talking about this as well. So let's understand what is WCC. WCC represents the blend of cost of company's various source of capital, including debt and equity. So basically, company finances its capital portion from two sources, that is debt and equity. Debt is something that you borrow from any organization. It may be person as well sometimes, by paying certain amount of interest on it. While equity means the portion of capital that you provide to general public or anybody, and you give the ownership of the company, and that is equity. And the cost of this debts and equity in combination is called WCC, and that is also called as weighted average cost of capital. What is its importance in decision making is that WCC is a critical input in capital budgeting, as it serves as the discount rate for evaluating investment project. It means that minimum cost or minimum return that the company project has to get back, or it has to own in order to fulfill the cost of the company that it is paying to the debt holders, to the equity holders, and in order to meet the cost, and it has to cover the WCC at least. Now, so After covering the WCC and over from that WCC data, it is the actual profit of the company, it is the actual return of the company. So WCC is the minimum rate of return that the company has to make from such project. So the knowing understanding of WCC helps that what rate that company has to make the return at any cost that we can know from this WCC. So optimizing capital structure, this is important in optimizing capital structure as well. Companies seek to minimize their WCC by finding the right balance between the debt and equity financing. So what happens is we might not know the portion of debt and equity that we need to borrow in order to financing. So by knowing the cost of debt and by knowing the cost of capital, then we can combine the portion of equity and debt so that we can afford that and we can make such return by utilizing such funds. And the understanding of this WCC helps to optimizing such capital structure as well. So practical implication of cost approaches. We have already talked about costing approaches before. Where does such costing approaches utilize in business life? Then we'll be talking about this as well. That costing approaches helps in pricing decision. So in costing approaches, it's nothing. It's the process of calculating the actual cost of making the product. That over from that cost, then we'll make the profit from that, and we have to know the cost of product in order to make the profit from that. That costing method helps us to determine the price of the product, and so that we keep some margin from that and sell to the consumer with the final selling value. So to know about the pricing and to know about to make the pricing decision, this costing approaches plays a very important role. Profitability analysis. First we determine the cost of the product, and then we put some amount of margin on the top of that, and we sell that product to the end person. So in order to determine the profit and in order to have the profit on the product, at first we need to know about the cost of that product. So after knowing the cost from the costing process, then we can only determine the profitability analysis, and we can only analyze the profitability after calculating the cost of the product. So this is a very also important aspect of costing approaches. And performance evaluation, that after knowing the cost and after knowing the profitability, then we can know the actual performance of our company. Then at what rate we are being able to produce the product, and at what margin that we are going to sell, and the overall performance and overall sales and overall costing and everything that the company does, and company's performance can be determined and analyzed from this costing approaches. So we'll move to another slide. Evaluation, incorporating the cost of capital in capital budgeting. So that importance of cost of capital, calculation of cost of capital is very important in capital budgeting. And so after calculating the cost of capital in capital budgeting, we can identify funding sources. We always tend to borrow the money where the cost of that money is less, and we always exclude the sources of money where the cost for that particular source and financing method. So it helps to identify the funding sources. At first, we'll borrow the money from the source that has that lower cost of capital, and we'll move to another. If that is not sufficient, then we'll move to another source of financing after fully utilizing the lower cost of capital sources. So it helps to identify the funding sources as well. Estimate the WCC. Calculating the cost of capital helps to estimate the WCC. We have already discussed about the WCC. It is the minimum rate of return that company has to earn in order to cover the cost of the capital that is borrowing from either the debt or from the equity sources, and it is the minimum rate of return that company has to make. So It helps to estimate the WCC as well and apply WCC to NPB. The NPB, we have already talked about NPB as well. That is net present value, and the WCC can be applied to NPB calculation as well. So we will talk about sensitivity analysis and risk assessment and their importance as well. Interest rate sensitivity, it helps to analyze the impact of changes in interest rate on the project's NPV and IRR, and cost fluctuation, and it helps to evaluate the sensitivity of the project's profitability to variation in input cost and the demand uncertainty. It also helps to assess the project's resilience to change in market demand and sales projection. Sensitivity analysis and risk assessment has the importance in these particular sectors, that is interest rate sensitivity calculation and assessment and cost fluctuation evaluation and demand uncertainty. In these areas, this sensitivity analysis and risk assessment helps, and that we use in practical life. So integrating costing, capital budgeting, and cost of capital. So at last, we'll be talking about integration of this costing, capital budgeting, and cost of capital. So costing approaches, it has practical implications. It's practically applied is that it helps to provide accurate cost information to support pricing, profitability analysis, and performance evaluation. We have already talked as well. As first, at first, we evaluate the cost of the product, and then we put some margin on that, on top of that, and we'll sell that product to the final consumer. So costing helps to determine the cost of the product, price of the product that we are being able to make or produce or manufacture in our company, in our organization, in our factory, and it helps to determine the profitability as well, and it helps to evaluate the overall performance of the company from the profitability, from the sales value, and from the cost of the product. So capital budgeting technique helps to evaluate the viability and profitability of the long-term investment project using methods like NPV and IRR. So basically, capital budgeting helps to determine whether you have the like optimum, you have the limited resources of money, and you have the multiple options to invest. So in that case, you will determine the profitability and the feasibility of all those projects, and their rate of returns, and their suitability of investing on such project, and we'll compare all the projects at once, and on the basis of capital we have, on the basis of resources we have, we'll put our money on the basis of profitability and on the basis of viability of such projects, and allocate our resources to such projects on the basis of their investability, viability, or profitability. You can say that. Yes, we have different metrics for that. We can calculate NPV, IRR, the payback period. So it helps us in such areas. We have, like, basically we can also say that it helps to optimally utilize our resources that is limited with us, and it helps to utilize such resources optimally and maximize the profitability. We can say that. Cost of capital. Cost of capital involves the discount rate used in capital budgeting decisions, ensuring investment aligned with the company's financial strategy. So we borrow the money from different sources, and the cost of capital helps to know that at what return and what cost we have to pay for such. For such that financing for such capital that we borrow from different sources of financing, and it helps to determine at what minimum that we have to make at any cost from such project in order to bear the cost of that capital that we borrowed in the process of financing. So by integrating these concepts, organization can make more informed strategic business decisions, leading to improved financial performance and sustainable growth. So this much for today. Thank you for listening.